Welcome to vTalkInsight, Market Drivers Daily for January 1st, 2026. We start the year with markets wrestling with three big questions. Can artificial intelligence keep powering returns? Is the global growth rebound for real? And how long can today's cross-asset divergences persist? Let's get straight into what's driving markets now. Artificial intelligence remains the central engine of both the macro story and equity leadership. But the question for 2026 is shifting from hype to hard returns. Over the past few days, the focus has already moved from simply owning anything AI related towards scrutinizing monetization, funding resilience, and physical constraints like power and data center capacity. Today's signals reinforce how deeply AI is now embedded across chips, infrastructure, credit markets, and even the labor data that feeds into policy decisions. On the infrastructure side, capital deployment remains intense. NVIDIA is ramping production at TSMC, while Chinese tech firms have reportedly ordered more than 2 million of its next-generation chips for 2026, pointing to sustained demand and ongoing supply chain tension. Data center specialists such as Digital Realty, Equinix, and Applied Digital continue to secure significant AI compute bookings, with 2026 shaping up as a pivotal year for data center real estate, when investors decide whether current capital expenditure fears give way to a renewed build-out cycle. Energy is being rewired to support this growth. Chevron is working on off-grid, gigawatt-scale natural gas power for data centers. EQT is positioned for rising gas demand in the Appalachian region, and Ford is pivoting some battery capacity from electric vehicles towards stationary storage for these facilities. Market leadership inside the AI complex is also rotating. Investor enthusiasm is broadening from core chip makers toward infrastructure builders, power equipment suppliers, and storage names, with hardware-focused companies like Western Digital, Micron, and Seagate outperforming while many software names lag as investors question near-term monetization. Companies with diversified models, such as Caterpillar and several Bitcoin miners, are benefiting from AI-related infrastructure demand while retaining other revenue streams that may offer more downside resilience than pure-play AI bets. Looking ahead, leadership is expected to shift from model development to distribution, where platforms like Google that already touch billions of users could have an edge. Institutional interest is even extending into AI-linked crypto assets through prospective exchange-traded funds, underscoring AI's reach beyond traditional tech into digital assets. The macro impact of AI on growth and employment is becoming more visible and more contentious. AI has contributed to stronger than expected growth in 2025, mainly through higher investment and equity market gains that boosted consumer spending via wealth effects. At the same time, the recent rise in unemployment appears driven less by broad weakness and more by reduced hiring, especially among younger workers, as AI substitutes for many entry-level roles. Large-scale layoffs in areas like call centers and driving highlight the pressure, while the U.S. labor market already faces a retirement wave and slower immigration, increasing reliance on automation to contain wage-driven inflation. Lower policy rates may not be a straightforward cure, because cheaper capital can accelerate AI adoption and further displace new entrants to the workforce. Political debate is heating up ahead of the 2026 elections, with growing calls for AI beneficiaries to fund worker retraining and for new frameworks to handle the widening gap between GDP growth and employment. Valuation and concentration risks sit on the other side of this powerful AI growth narrative. On one hand, current AI-driven tech valuations are described as grounded in strong earnings and capital investment, unlike the late 1990s bubble, with mega-cap players funding acquisitions and capex from robust free cash flow and manufacturers like TSMC growing cash flow, revenue, and operating income around 20%, while trading at lower multiples than NVIDIA. On the other hand, NVIDIA's own valuation has already compressed to around 26 times forward earnings as markets question future incremental buyers and the durability of very high growth rates. while free cash flow yield for leaders, such as Microsoft, are at record lows, and some AI infrastructure names trade at earnings multiples near 90. Heavy, concentrated AI capex raises the risk that if returns disappoint, the S&P 500 could face valuation pressure. AI-related issuance now accounts for about 14% of investment-grade credit supply, double last year, adding sector and credit concentration risk, just as skepticism lingers over whether productivity gains have really spread beyond large tech. Organizational bottlenecks, rising inference costs that may hurt firms like Meta more than Apple, and a surge in AI-driven scams and crypto hacks all reinforce that execution and risk management, not just exposure, are likely to drive outcomes. Key watch points now are revenue and margin realization on the massive AI capex programs, booking trends for data center REITs, labor market data by age and sector, and regulatory moves around AI and digital assets. Taken together, these will determine whether AI remains a healthy growth engine or tilts toward overbuild and repricing, and they set the stage for the broader growth picture we turn to next. The growth backdrop heading into 2026 is meaningfully stronger than many expected a year ago, even after allowing for pockets of weakness. In the United States, GDP growth has been robust, with third-quarter output around 4% and the fourth quarter expected to run above trend, suggesting the central bank's forecast of roughly 1.9% growth for next year may prove conservative. Baseline projections point to U.S. growth in the 2 to 3% range, near the top of the global league tables, supported by strong consumer spending, substantial post-2019 wealth creation, and steady employment. Globally, the MSCI World Index is on track for its strongest annual return in 6 years, reflecting a broad-based equity rally that has been reinforced by AI-related investment and wealth effects. This macro strength is feeding directly into earnings expectations. Forecasts call for S&P 500 earnings growth in the low to mid-teens next year, around 12 to 15%, with ongoing support for megacap tech, but also a broadening contribution for financials and industrials as AI-driven productivity improvements begin to filter through. Balanced portfolios have delivered double-digit gains this year, and expectations for 2026 are underpinned by reduced tariff headwinds, significant fiscal stimulus, and supportive tax policy and capital expenditure incentives that encourage onshore investment. Healthcare is another important pillar, with sector hiring expected to average about 60,000 jobs per month over the next 5 years, and the industry scene recovering on the back of better collaboration with regulators and strong deal activity, particularly in pharmaceuticals. Some of the more interesting growth stories sit outside the traditional tech complex. In U.S. housing, falling mortgage rates, higher inventory, and wage growth that is now outpacing home prices are improving affordability, setting the stage for a potential recovery in home sales in 2024 and beyond. In travel, strong demand for premium economy seats on outbound international flights, alongside greater availability and pricing power, suggests consumers are still willing to trade up an experience rather than simply cut back. Meanwhile, prediction markets are emerging as a distinct growth engine. Weekly volumes have pushed above $2 billion, with annualized flows of around $50 billion in California alone, and some see the sector reaching $1 trillion by the end of the decade. Regulatory signals from the commodities regulator point toward a more innovation-friendly stance, which could further accelerate adoption by reducing barriers for both brokerage and crypto-native platforms. AI-related infrastructure and international dynamics round out the growth picture. Applied Digital is seeing heightened demand for its data center capacity as hyperscalers value reliable delivery, while TSMC and Qualcomm illustrate how AI and adjacent technologies are supporting diversified, high-growth revenue streams, from automotive to connected devices and, increasingly, data center silicon. On the commodity side, EQT stands to benefit if data center-driven natural gas demand in the Appalachian region lifts prices, given its strong free cash flow and limited hedging. Outside the U.S., China is projecting GDP growth of about 5% for 2025, helped by the first expansion in factory activity in 9 months, a combination that could provide a constructive backdrop for Chinese equities and for commodities leveraged to Chinese industrial demand. Despite this constructive backdrop, the expansion is uneven and comes with clear risks. The U.S. economy is described as highly bifurcated, with large firms and affluent consumers thriving while small businesses and lower-income groups face contraction, particularly in manufacturing, real estate, agriculture, and transportation. Structural headwinds, such as a retirement boom and slowing immigration, increase dependence on AI to offset wage pressures. Yet significant productivity gains are not expected to materialize broadly before 2026, leaving a window where job disruption may run ahead of visible efficiency gains. Rapid adoption of generative AI is contributing to layoffs in sectors like call centers and transport, and there is concern that lowering interest rates might inadvertently speed automation by cutting capital costs without meaningfully boosting net hiring. At the same time, yield curves are steepening as both 2-year and 10-year government bond yields rise on better-than-expected jobless claims, signaling resilient growth, but also the potential for higher discount rates. Rotation themes reflect this mix. Investors are looking toward financials and industrials tied to data center build-out and reshoring, while small caps may lag under the current rate environment. The key for markets is where this growth ultimately accrues and whether earnings can keep pace with lofty expectations. The past year delivered strong absolute returns, but also some of the sharpest divergences across assets and regions that we have seen in this cycle. U.S. equities posted double-digit gains. The S&P 500 rose about 17%. Both stocks and bonds rallied. The dollar weakened, and gold and silver recorded their strongest year since the late 1970s, all against a backdrop of global acceleration that pushed the MSCI World Index toward its best performance in 6 years. Beneath those headlines, though, leadership has been anything but uniform, and 2026 is likely to be defined by these rotations rather than by a single, one-way risk rally. One of the clearest divergences is between U.S. and international equities. After years of U.S. dominance, global equities outside the U.S. have begun to outperform, with European markets such as Germany and Spain delivering standout returns and the main European blue-chip index nearly matching the performance of the U.S., so-called Magnificent Seven in local currency terms. European equities have outpaced most major U.S. indices, and international markets are seen as offering significant upside in 2026, helped by generally less stretched valuations and the prospect of Germany moving towards significant fiscal stimulus, alongside elevated European defense spending that is expected to stay high for at least another 6 months. That said, much of Europe's recent outperformance has been driven by price-to-earnings multiple expansion, which means the region is now less of a valuation outlier versus the U.S. than it was a year ago. Within U.S. equities, style and sector rotations are increasingly important. Even as the headline index advanced, defensive sectors and selected international stocks, particularly in Germany and Spain, outperformed, and there is a growing view that the equal-weight S&P 500 could beat the market cap-weighted version as leadership broadens beyond a narrow group of mega-cap AI winners. Market leadership is already rotating from pure tech towards cyclicals such as financials and industrials, with expectations of further rotation into banks and industrials tied to data center construction and reshoring, while small caps may underperform in the current rate environment. After a year of strong outperformance by investment banks and brokers relative to traditional banks, some argue that spread is unsustainable, favoring a catch-up by large, stable banks over more market-sensitive brokers. Dispersion is just as pronounced at the sector and single-name level. In the energy complex, investors have rotated out of the sector toward perceived havens like utilities, yet some large integrated names, such as ExxonMobil, are trading near 52-week highs, and gas-focused producers with AI-linked demand exposure, like EQT, show how idiosyncratic fundamentals can trump broad sector trends. Retail has been similarly split. Discount chains including Five Below, Dollar General, and Dollar Tree have significantly outperformed, while specialty and department stores have delivered mixed results depending on execution and leadership changes, even though the overall U.S. retail consumer has remained surprisingly resilient despite shutdowns, tariffs, and the resumption of student loan payments. In media and streaming, the strategic direction for players such as Comcast, Paramount, and Warner hinges on the outcome of the Warner Discovery battle, with non-native streamers facing rising pressure to restructure or combine to stay competitive. Within AI and digital assets, the divergences are arguably even starker. Hardware-focused AI companies like Western Digital, Micron, and Seagate have outperformed as investors gravitate toward clearer demand from data centers, while software names lag amid skepticism about near-term AI monetization and organizational bottlenecks that slow enterprise rollout. Some AI infrastructure-related stocks, such as Vernova, now trade at exceptionally rich valuations, reportedly up to 90 times estimated earnings, which leaves very little margin for error if demand growth slows. By contrast, companies with diversified business models, including Caterpillar and several Bitcoin miners, are benefiting from AI-driven infrastructure demand while retaining other earning streams that may provide more resilience if AI spending normalizes. Crypto markets tell their own divergence story. Major coins like Bitcoin and Ether underperformed in 2025, posting annual declines even as the S&P 500 gained nearly 17%, despite signs of improving fundamentals such as regulatory progress and rising institutional adoption. Institutional interest in AI-related crypto assets is building, with new ETF filings targeting tokens like Uniswap, SUI, and Tau. Yet crypto crime surged to $2.7 billion in hacks last year, more than half attributed to North Korea, and AI-driven scams are estimated to have jumped by 500%, underscoring the gap between structural development and near-term risk perception. Looking ahead, some expect the current bull market to persist even with stretched U.S. valuations, supported by ongoing global reacceleration, but with greater emphasis on diversification across regions, sectors, and styles. Key signals to watch include relative earnings revisions between U.S. and non-U.S. markets, confirmation of German fiscal stimulus, and sustained European defense spending, performance spreads between banks and brokers, small caps versus large caps, and flows between equities, crypto, and precious metals. How these divergences evolve will determine whether 2026 feels like a broad continuation of 2025's rally or a more selectively rewarded environment. Stepping back, three forces stand out as we open 2026. Artificial intelligence is still the dominant macro and market driver, but the focus is shifting decisively toward realized returns on massive capex, labor market disruption, and valuation discipline. Growth expectations remain constructive, with the U.S. and key international economies running ahead of earlier forecasts, while sectors from housing and healthcare to prediction markets and AI-driven infrastructure add new engines to the expansion. At the same time, cross-asset and regional divergences are deepening, making leadership, concentration, and stock or sector selection far more important than the index level alone. Watching how AI earnings, housing and healthcare data, European fiscal decisions, and crypto regulation evolve will be critical for understanding where risk and reward are shifting. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.